Okay, so the topic for tonight is sort of macro themes in the crypto markets. First of all, I'm Charlie. Thanks a lot for letting me take this time, and hopefully I'll say something at least mildly intelligent. And you know, maybe some of this won't be news to some of you, maybe it will be, I don't know. I'm gonna tell a story in pictures, so you know, we just heard that, you know, we don't want to put up price charts, but I love charts, I love data, and we're gonna tell a story in pictures. The goal is not to, you know, make any representation about, you know, is it going up or down, but just to give you a framework for understanding kind of some of the salient issues in the market, what we see in the data, and then a bit of discussion. And I'll try to leave a bit of time at the end for Q&A. You just want to make sure I know when there's like 10 minutes left, so, because we have like half an hour, right? 25, okay, cool. Great, so I'm Charlie. I'm the head of markets at blockchain.com. I joined blockchain in October 18 when I sold my company to blockchain. That was awesome. We've been doing machine learning for trading and sports betting, which amazingly is quite similar to crypto. Blockchain liked the stack, and I thought crypto was way cooler than sports betting, so and had more scale, most importantly, and so that's kind of how we ended up there. Who's blockchain? We're an industry pioneer, it said so on the slide, so it must be true. We have 45 million installations of our wallet app. We're the largest endpoint for a non-custodial wallet in the world. We think that, you know, from observing on-chain activity, our wallet is something like 20% plus, maybe more, of all activity globally on the Bitcoin blockchain, at least by ticket count. We've got an exchange now, custody, smart order router, and we've built up a nice little lending business that's growing tidily, and we're quite excited about that. And there's plenty more to come. So you can think of us as kind of the endpoint on the non-custodial side, and now we're kind of forward integrating into other financial products. Okay, so here are some of the themes that I'll hit on today. I think it's a story about basically, now that we've worked off the hangover, the epic hangover of 2017, and started to wash out some of the froth, market's consolidated, it's on healthier footing, and it's getting on doing what it does, which is slowly but surely eating the banking system, which is awesome. So there's a couple of big themes here to touch on. The first is that the fund ecosystem is growing, and we see allocation in. The second is the cross-asset story for Bitcoin, particularly, is alive and well, with great, great characteristics there from a portfolio allocator's perspective. And then we'll talk about some of the recent developments in the lending market, which have been super interesting and have got a lot of headlines. And then we'll do like a little tour of what on-chain data says, a bit of chart stuff, and then we'll talk about some of the other thematic issues in the space. Okay, so here's a smattering of headlines from the last quarter about funds in the space. And what's interesting is crypto hedge fund doesn't quite mean the same thing as regulated asset manager for financial products in traditional sense. So the size of your typical fund is 20, 30 million in crypto, so not huge by kind of the traditional standards. But the activity is there, and the performance has actually been there too, which is interesting because a lot of these guys kind of look like stock pickers, fundamental stock pickers, and then quant guys. I'd say it's kind of those two things. But people have done okay basically on risk management, at least up through Q3 of last year, because the market trends so hard, and basically people eventually stop out or stop in, and so as long as the market trend signals kind of work like that. I wouldn't be surprised to continue to see some outperformance. Interestingly here's our first picture, okay? In green, the Bitcoin price. In white, the open interest on the CME. You'll notice a huge uptick with the turn of 2019 into 2020. I don't know if this is indicative of increased institutional demand. The total size is still small. It's only about 5,000 lots or 25,000 coins, so it's not that huge in the context of the broader crypto market, certainly not by OKX or BitMEX derivative standards, but it's something. And what's interesting about it is these participants actually have dollars, which is sort of different than, and so I think the flows probably matter more from a price discovery perspective on something greater than a 1 second interval for these guys. And so I think it's a pretty interesting trend. And I think the other thing that's super notable is the massive uptick with the turn of the year. It's like I was waiting to buy the dip. Now I'm through the end of the year, and now I can do stuff, which is pretty cool. Okay, secondly, in white we have the ETH Bitcoin cross. You see Ethereum massively outperforming versus Bitcoin into the year. Altcoins are rallying. Is that allocation of new funds? Maybe. Is it retail looking for leverage but doesn't want to trade or understand derivatives? Maybe. Is it a bounce back after selling off 95% in altcoin land and it's a dead cat bounce? Maybe. Could be all those things. All I know is that people seem quite excited about the ongoing prospects for DeFi. ETH appears to be the leading contender as the rail, and all these sort of second generation projects. They're hitting their milestones, carrying on. User adoption is a different thing away from ETH, but people seem quite enthused about like platform, new platforms and so forth. So altcoins are rallying. So here's a graph of the intraday price action of Bitcoin and gold since the beginning of 2020. What's super interesting here is that on the Soleimani assassination headlines, which was a pretty big risk event for the broader markets, gold roofed, you can see that in gold, and Bitcoin, which is in white, also performed, and it performed contemporaneously. So as a macro cross hedge, it sort of is doing what it says on the tin. You have all these people banging on Twitter, including me, about how Bitcoin is this really interesting inelastically supplied asset, and it's this, the hardest hard asset is entirely virtual, isn't that amazing, and all these cool things. And here you go, it's in the tape. And that's a very, very powerful narrative for the cross-asset allocator, because you're saying, like, it's gold, but more so, right? Now, it's a little hard to see with the scaling, because there's a subtrend in there, but Bitcoin's, from a percentage performance, massively outperformed gold. I just didn't index it to 100 in the chart. And then the second thing is, here we have the coronavirus scare. Is that driving Bitcoin? Maybe. We'll investigate that in a little bit. Gold's up and down, a bit of maybe we're going to re-rate growth. Actually, the Fed's easing after all. Bitcoin doesn't care. It's just going to continue going up, and the headlines matter on China. Okay, a quick digression into broader macro. In yellow, we have the dollar index. In white, we have US real yields, so that's interest rate swaps minus zero coupon inflation swaps. Okay, you can see quite negative and going down, right? And in purple, we've got the gold divided by copper ratio. In this case we have copper divided by gold. I've got it inverted on here. Why is that interesting? Well, gold is like the anti-growth asset in macro terms, and Dr. Copper is a proxy for industrial production globally. And what's interesting, if you take the ratio, is you're kind of taking a pure growth factor out and kind of normalizing away the dollar risk, because the dollars get canceled in that ratio. And so what you see is global growth expectations trended down through the beginning of 19, have kind of faffed around a little bit, and taken an absolute dirt nap in the beginning of 2020. And interestingly, the dollar price action is sort of like a little bullish, but it's not really a dollar story. This is about real world growth, and real world growth looks like doesn't look great. Meanwhile, Bitcoin, as a proxy for Chinese risk, appears, this is a correlation that's been sort of noted many, many times in the financial press. In green, you have the Bitcoin price, and in yellow, you have the Chinese yuan versus the dollar. Higher is weaker. And what you see is at least some kind of tracking, but it looks like Bitcoin has sort of anticipated the move or led the market a bit, which is pretty interesting. And it kind of makes sense, because the dollar flows in Bitcoin, the fund flows in Bitcoin, it takes a lot less movement of money to discover the price, and it's a lot less, I would say, intervened in, shall we say, by authorities than some of these other instruments. And again, the gold-copper ratio, in this case, gold is at the top of the denominator, so higher means weaker growth, but it's the same purple line as in the last chart. Again, sort of indicating, that all these things are related to basically fundamental, real-world, real economy growth in some way. Okay, so here's an interesting picture. Again, the blue line is the Bitcoin price, and the yellow line is our estimate of the premium for Bitcoin in dollar terms onshore in China. So what you can see is that the recent movement in the market, the beginning of the uptrend was met with a discount onshore in the Bitcoin price, suggesting that the initial demand in this move is not really Eastern driven, and that premium has ticked up and up and up, and is now sort of saying, the market is basically saying send Bitcoin, which is pretty interesting, and that's particularly interesting in the context of the funding dynamics. Here, that orange chart is the same chart of the Chinese premium onshore. So take the Bitcoin price in RMB, divide by the RMB exchange rate, subtract the Bitcoin price. And a higher orange line means send Bitcoin to China, basically. And here you see, historically, that's tended to be opposite of basically the funding dynamic. So, when dollars are plentiful, which is sort of like when the BitMEX funding rate is negative, right? The premium has been high on certain occasions, and recently they've been moving in lockstep. So that's pretty interesting. When dollars are plentiful, it means Bitcoins are hard to borrow, dollars are easy to borrow, and it's sort of said like, oh, Chinese demand is there, but Western people are fading the Bitcoin move, and they want to borrow Bitcoin to sell to the Chinese. Right now, it's like the Chinese are buying, and the market wants to lever up to anticipate additional Chinese demand, perhaps. Or wants to just get long because it believes in the trend. But basically, the synchronized move in the funding rate, suggesting scarcity of dollars needed to buy and lever up the market, is there. I think another way to think about it is, onshore in China right now, you have a growth shock that's super, super meaningful. Now, I think there's a big open question mark about how transitory or persistent that shock is. I read a lot of conspiracy theories on Twitter, so I might have a different view about how long that's going to last or what the real numbers are. My view isn't important. What is important is that if the shut-in of the citizenry persists, it will be a shock to growth. And you're talking about a demand shock of like basically the first magnitude in the world's most leveraged jurisdiction, right? And so if people were anticipating, an inflationary response to prop up the leverage in the financial system, which has certainly been observed in the last few days with something like $200 billion of stimulus by PBOC, right? Then you might say, aha, like I want to buy hard assets, right? And buying hard assets is easy to do in digital assets because they just move across borders quite freely. So if it's onshore demand pulling the price higher for physical coin, right, then the rest of world system could just, if the market doesn't want to fade it, could run out of dollars quite quickly, because when Bitcoins get purchased for RMBs, the RMBs can't leave the onshore Chinese system because of the $50,000 a year capital control, right? Therefore, the dollar flows on this side, despite the earlier sort of footprints I showed you in pictures of institutional allocation to the space, probably just can't keep up with the demand, right? By the way, the alternative interpretation of the richness of the funding expense right now and the scarcity of dollars in the system is that the market's trending higher, people are too bulled up, everybody's bullish, everybody wishes they bought lower, and it's just over-levered and long, right? Now, what's interesting about this is from a what's the future price action going to look like in kind of the short run, if the system's just levered long, which it surely is, but if it's just levered long without an end demand sink, price is going to go down, right? The commitment of traders report, to put on my sort of traditional commodities hat, is overextended, and it's going to mean revert, right? If you think instead that we're seeing a new source of demand that maybe didn't exist before, and I'll point you to the recent Chinese inflation data where food prices are up 20% year over year, pork prices are something like doubled, and I think, and core CPI is up 5 or 6% in the context of PPI trending massively lower, which is very, very different than the framework we've seen there for a long time. That's conducive to retail buying of hard assets, and if that's the case of what's going on, then it would make sense that dollar funding conditions would get squeezed because the dollar inflows in the Western system are not, they're lagging, not leading the price action, right? And so it would make sense that the futures curves would go into steep contangos and the funding expense would get bridged. Okay, which brings us to the lending market. A lot of headlines, a lot of noise and bluster about the space. I think people are impressed, generally speaking, with the growth of the loan market. I think we've been pleasantly surprised at blockchain.com with the pace of activity. I think there's also some skepticism. Every time credit moves, people drop the B word and say bubble. I guess it's important to try to separate fact from fiction here a little bit. But this has been a huge theme in the market, which is basically finding ways to deploy some of that unencumbered wealth that's been created in the form of asset appreciation in digital assets. And so there's, basically the lending platforms out there in the space are doing well, but there's still some pretty big challenges ahead. So some stylized facts. First, across various lending platforms in the space, both institutional and retail demand is growing, and the growth has been strong, and there's plenty more to come. I think some of the institutional demand is sort of trading account related, but not all of it. Encouragingly, I think we see interesting lending demand for crypto away from just here's a market maker that wants to have inventory, or here's a guy that wants to sell something short, but more like working capital for real businesses in the space. And other kind of structured finance type opportunities, which is pretty interesting. And then on the retail side, there's been a number of platforms that are growing, and generally speaking, the LTVs are conservative. So I don't think it's crypto is super volatile. So it's collateral that needs active management, active margining, active asset servicing, and so forth. But to be fair, calls for a credit bubble, I think, are pretty untoward, given the amount of leverage, that's in the system from the derivatives markets, right? Like, I think I read maybe on BitMEX's blog that their average customer is something like 20 turns of gearing, or a significant portion of the customer base is 20 turns of gearing. That's what's driving crypto volatility, not 50 LTV lending against guys with margin top off. So I think it's pretty important to note that from a market structure perspective, surely leverage sweeps are a daily fact of life. That's why the price action is so gappy. I think everybody knows that, but it's not the physical lending that's driving that by and large. Now, what could make the market better? I think increased standardization on docs is clearly something that needs help. And alongside that, basically more standards around collateral servicing, collateral management, margin calls, trustworthy tripartite counterparties with good balance sheet, not just good technology. Those issues are important, and are going to serve to basically help get those dollars that are needed in the ecosystem into the ecosystem. And like I said, there's working capital, all kinds of other stuff to do, and then we talked about the dollar scarcity already. But I think a really important point about the dollar scarcity is that, as you saw in that first chart, real yields in the real world are negative. And we talk a lot about institutional adoption, but here's a pitch for an institution that's not that sexy. I've got an asset, it has 70% per year or worse volatility. It's going up because we think it's cool. Buy it. Right? Great sales pitch. Like, by the way, I was totally convinced by that. It's not fine by me, but most people, it's not so much. Your average institutional capital allocator, a better pitch is real yields everywhere are negative. You have a mandate to earn yield. This market is growing, and real yields are very, very positive. How about you lend prudently into the space with sensible people and help the growth of the product suite, make this stuff more useful, and by the way, you've got, like in any lending business, there's some risk, but you've got, the vast majority of the time you're going to get your principal back and all your interest, right? That's a much, much stronger economic incentive for the vast pools of institutional money that are out there for fixed income. And the way to convince people to do stuff is with price, right? And the crypto market right now is saying, dear real world, It's pretty cool up here on the moon. It's a great view, but there's not too many people. P.S. Send money. Right, and it's saying that with the price mechanism, which is of course the most convincing mechanism you can have. And now obviously for lending, like, you know, before I ran metals at Goldman Sachs, before I was a startup guy, I ran metals at Goldman Sachs. Before I ran metals at Goldman Sachs, I was a mortgage trader. And, you know, as a credit guy, I'm deeply cynical, and like that's all about, you know, any dope can lend money, it's getting it back, that's the hard bit. You know, so it's all about a price signal subject to a threshold of credibility and sensible governance and sensible collateral packages, sensible servicing, sensible origination and compliance. And that infrastructure, you know, while we were all kind of doing penance working off the 2017 hangover, that infrastructure's been built. Or is in the process of being built at a rapid clip because the price incentive is saying to do it. And those dollars are coming in, and I think it'd be like an amazing irony if the much vaunted, long scarce institutional adoption of crypto in the end is driven by demand for yield for dollar bills, right? That's kind of crazy, but you know, that's a market. So that's the lending business, and it's a huge thing that's going on in the space right now. Okay, now we're gonna have a little digress. How am I in time? We're okay? Okay, so 5 minutes, okay. So, quick, we're gonna be quick here. The blockchain is healthy, the hash rate is high, transaction value is sort of trending up but volatile in line with the market, okay? The realized cap of Bitcoin, which is basically take every Bitcoin on the Bitcoin blockchain, assume the price at when it last transferred to its address, and try to figure out basically the cost basis of the market. That ratio versus the actual price is right about 1.5 right now. That's come down faster than the market's come down recently and really kind of opened up a gap. The lower that is, sort of the more kind of like closer to cost and more solid you are, and the less sort of, you know, unrealized profits are burning a hole in people's pockets. That number has been as high as 4 or 5 in recent memory. So we're pretty healthy. The low tick, by the way, in December of 18 or whatever was like 0.75. Okay. Here's an estimate of the average seller's profit for on-chain transaction. I think this is a 1-day average, so take every UTXO movement in every block and look at its historic cost basis. There's definitely profit-taking of incumbent holders of crypto in this move, but it's orderly, which suggests we're not at a blow off top. And in fact, it's pretty healthy because it's saying, again, it's keeping that NVRV low and basically saying there's conviction around the price and people are getting the liquidity they need to cycle the inventory. This is yesterday. In 6-hour blocks, that same metric, you can see something came out and it, you know, looked, you know, reasonably like something more substantial came out. So it's, you know, and that tends to put in local tops. It did kind of drop for a bit, and then we've kind of gone higher again today. Same thing here, basically the uptick in Bitcoin days destroyed is showing basically that vintage Bitcoin is starting to transfer with this move in price, suggesting, you know, real turnover, and so on. This tends to be an indicator of tops or bottoms. And then finally, interestingly, this is an estimate that we have from our on-chain analytics of the number of wallets transacting. This is kind of an estimate, an upper bound. It's not the number of addresses, it's the number of, you know, we try to cluster the addresses by wallet. And what you can see is a dispersed movement more granularly on-chain, suggestive of, you know, broader participation in some kind of you know, action on-chain. And in fact, this estimate is higher than the top of the bubble in 2017 right now, suggesting broader, you know, distribution and participation on the Bitcoin network. And totally consistent with the idea that maybe Chinese retail is living out. Here's some technical analysis, have to have its crypto presentation. Basically, the fibs at 9,900 and 10,200 are big levels on the longer term charts. That's all I have to say there. But the market's overbought right now. We're at the top of a Bollinger Band, and you know, you can see up there on the right, and then you know, we're kind of like in the danger zone on the RSI, although it can definitely go from here. So that's the story in pictures. Now here's all the other stuff. Away from just like the price action of the market. So I think the takeaway on the market is, if the market's just overextended and long and there's no Chinese follow through, we're going down. If there's Chinese follow through, we're going up, and we're going up a lot. And I think there's circumstantial evidence in favor of that latter case, but not yet really confirmed. Now, other themes that matter in the market the whole CBDC thing, basically Facebook and Libra and the Chinese digital currency are shot across the bow to Western policymakers. I still think that they don't really understand the value proposition of stablecoins or building, a system built around bearer assets. That solves too big to fail, but we'll get there eventually. And then I think the other big thing is the regulatory activity against ICOs with the sort of like STO, pushback on Telegram and Kik and Libra. And there it's like, because the exchange tokens are kind of the first implementation of community-based, securities tokens or utility blend hybrids that kind of look well and have performed well and are driving community adoption. I think you're seeing the beginning of basically a new and kind of orthogonal rail for capital formation. We already know this product market fit there because of the ICO craze. And now people are doing it, in ways that are more jurisdictionally compliant. And sure enough, basically co-participating in the economics of your ecosystem does in fact drive adoption and create community buy-in. And so this kind of theme around frictionless capital formation, disintermediating the rent seekers in the existing capital markets, I think is a really interesting idea, and it's a space to watch, but it's going to be a while as it develops. So I try to do it fast. Am I good on time?
No, you're good. Got a minute.
I've got a minute or two. I have time for a question or two, I guess.
I have a question also. Do we have a question?
I've left you speechless, okay? Yes.
Yeah, you talk about China being quite an important actor in bringing the price level up. What's the leading indicator that you would use to see that sort of growing Bitcoin volume in China?
Well, I think, ultimately in the end, if you're telling a story of hard asset, diversification as an investment product in the face of inflation, that's one thing to watch. To watch in the market, like I said, I think the onshore premium are the obvious signal. And then there's lots more work to do, I guess, on chain. And then, of course, CPC policy, but they've kind of gone back and forth on how hard they clamp down on it, so. Yeah.
In terms of the Chinese growth shock and Bitcoin and crypto as a hedge against that, what's the possibility of Chinese retail going to a hard asset that's a stable coin and not choosing Bitcoin, and therefore maybe Bitcoin's overbought, and what would that mean for Bitcoin in the longer term?
I think it's a great question, and the possibility is certainly there. But people like momentum too, right? So there's definitely an element of sort of autocorrelation and returns chasing on this stuff. So and stablecoins don't have that sort of same sex appeal. So I guess we'll see. Yeah.
What's your opinion on the long-term effect of Tether on Bitcoin and crypto in general?
Too hard for 30 seconds left. I'm going to punt on it. I think it's it's a obviously extremely interesting development in the ecosystem, and we'll see. I think the big question is is the regulation light pathway, a feature that is desirable for its users, and all evidence seems to suggest that is the case. So, yeah.
Cool. Excellent. Thank you very much, John.